Welcome to Finance for World. In today's explainer, we're unpacking exactly how institutional experts are positioning their portfolios right now. We're looking at a fascinating, almost wild collision of forces. We've got this delicate balance between intense geopolitical tensions on one side and this absolutely incredible AI-driven optimism on the other. It's like a giant puzzle where breakthrough tech is driving massive earnings growth while shifting geopolitical sands are keeping literally everyone on edge. So let's dive into the core question dominating wealth management strategies worldwide right now. How exactly do you invest during a fragile equilibrium? I mean, how do you protect your capital from sudden inflation shocks, but still capture the historic upside of this AI boom? It is a seriously tough balancing act, but thankfully, the data gives us a very clear roadmap.
To break this down, we're following a top-down agenda today. First, global markets at a crossroads. Second, 3 scenarios for the economy. Third, equities riding the AI wave. Fourth, why gold and oil shine. Fifth, fixed income and currency plays. And finally, the key takeaway.
All right, starting with Section 1, global markets at a crossroads.
To give you a perfect example of the current market fragility we're seeing, look no further than a recent ICICI Direct report. It highlighted the Sensex dropping over 600 points right from its intraday high. That sudden drop completely wiped out early gains, and it really reflects that deep, underlying global uncertainty we're feeling. Technical resistance levels are being tested hard, and sentiment is just turning cautious the second global headlines hit the wires. Now, looking at this quote from U.S. President Donald Trump, what's truly fascinating is how directly these geopolitical statements immediately impact market sentiment. When you get comments like this regarding Iran, hopes for a quick peace deal over the critical Hormuz Strait just vanish. And remember, we aren't looking at this politically. We're looking at it purely through the lens of market mechanics. The market absolutely craves certainty, so statements that highlight the potential for resumed conflict instantly trigger protective, risk-off behavior. So what's actually driving the bus here? Well, these specific market pressures are exactly what's causing caution across Asian and European indices. Investors are forced to closely monitor fresh U.S. Central Command strikes, delayed Middle East negotiations, regional volatility like the nifty F&O expiry, and crucially, elevated crude oil prices. It's this heavy, compounding effect of local and global pressures, a stark reminder that a headline a world away can reprice a local portfolio in a heartbeat.
So where do we go from here? Let's move to Section 2, 3 scenarios for the economy.
Based on insights from Standard Chartered, the data points to a pretty clear base case. Institutional experts are assigning a 60% probability to a soft landing. But for this core scenario to actually play out, it assumes the Hormuz Strait reopens within weeks, avoiding a major oil shock, and that the Fed manages to cut rates by 25 basis points by the end of 2026. Basically, it's the Goldilocks scenario, right? The economy cools down just enough to tame inflation without triggering a massive recession.
But we have to weigh the alternatives. There's a 20% downside risk of a hard landing, which could be triggered by a prolonged Hormuz blockade that spikes oil prices and causes a massive stock and bond sell-off. On the flip side, we've got a 20% upside scenario. If a Trump-Xi meeting improves global trade and we see fiscal easing and tax cuts, it could completely revive what economists call animal spirits. That powerful psychological surge in investor momentum.
Moving right along to Section 3, equities riding the AI wave.
Let's see how this macro foundation translates into actionable strategies. The crucial point here is earnings growth, and you simply can't ignore these numbers. Consensus estimates are now projecting a massive 22% U.S. earnings growth for 2026. This isn't just speculative hype, guys. This is driven largely by foundational, structural AI capital expenditure. Big tech is spending billions to build out AI infrastructure, and that cash is flowing straight to the bottom lines of the broader market.
But hey, the opportunity is definitely not just in the US. The Asia ex-Japan market is incredibly dynamic right now. Experts maintain an overweight stance on Taiwan because they are quite literally building the hardware for the AI wave through semiconductor structural growth. China is also overweight due to some massive valuation discounts and active policy support. In India remains overweight, totally powered by robust, domestic-driven economic growth.
And here is the major strategic pivot we're seeing. AI earnings growth is broadening out. It's not just about the companies making the microchips anymore. Institutions are actively rotating their portfolios to capture this expansion as it moves into wider sectors, like the broader internet and communication services. This effectively broadens their equity exposure and acts as a fantastic hedge against concentration risk. Because let's face it, you don't want all your eggs in just one semiconductor basket.
But in a fragile equilibrium, defense is just as important as offense. That brings us to Section 4, Why Gold and Oil Shine. So, how are institutions protecting their equity gains? While gold is acting as a critical safe haven, experts remain strongly overweight here, setting a 12-month target of $5,500 an ounce. And this confidence is built on three main structural drivers. First, it beautifully diversifies the portfolio during market stress. Second, we're seeing incredibly strong sustained buying from global central banks, shifting away from U.S. assets. And third, gold naturally benefits from falling real yields. It's just in a massive structural bull market right now. At the same time, we absolutely have to talk about energy. Oil markets remain highly vulnerable to supply disruptions. Because global inventories are drawing down rapidly and the markets remain super exposed to those risks in the Hormuz Strait we talked about, institutional forecasts have actually bumped up the target for WTI oil to $90 per barrel over the next 3 months. Now, let's explore Section 5, Fixed Income and Currency Plays. Looking at how these markets are reacting to the exact same inflation and growth forces, we see a huge divergence in the bond market. There's a clear overweight preference for the attractive yields of emerging market bonds. The risk-reward profile there is just great right now. Conversely, experts are taking an underweight stance on developed market government bonds. Why? Because long-dated bonds in developed markets are highly sensitive and heavily exposed to the risk of renewed inflation shocks. If inflation spikes due to an oil shock, who wants a low-yield 10-year bond? No one. Those long-term bonds will definitely suffer. On the currency front, stronger economic data and elevated energy prices are keeping the US dollar index pretty firm in the near term. However, as interest rate differentials start to narrow over the next 12 months, experts are forecasting a gradual decline for the dollar index, down to about 96, and they expect the US dollar to Japanese yen pair to settle right around 152. Okay, let's bring all of this incredibly detailed analysis together in Section 6, the key takeaway. If you want to know which of those three economic scenarios is actually going to unfold, these are the specific macro factors you need to be watching like a hawk. Track the progress on the Hormuz Strait. Watch exactly how the Fed responds to stubborn inflation data. Keep a close eye on the economic fallout from upcoming Trump-Xi summits, China's efforts to stimulate domestic demand, and of course any rate hike signals from the ECB and the Bank of Japan. These triggers are going to directly dictate whether we get that smooth 60% soft landing or if we veer off into unexpected volatility.
The overarching theme from all this institutional data is crystal clear. Embrace the AI equity boom, because that earnings growth is real and it's broadening out. But whatever you do, do not get complacent. You have got to anchor your portfolio with strong defensive plays like gold, oil, and emerging market bonds. At the end of the day, diversification is your absolute best shield against lingering inflation and sudden geopolitical flare-ups.
It really is a masterclass in a delicate balancing act. And that leaves us with one final provocative thought for you to take away from today's explainer. Take a hard look at your own allocations. Is your financial strategy truly resilient enough to survive the shocks of this fragile equilibrium while still capturing the generational upside of tomorrow's technology? Thank you for joining us today. Keep your eyes on those macro indicators, and we'll see you next time.